When he was just 19 years old, a young Warren Buffett picked up a book that would change his life and define his entire approach to investing. It wasn't some thrilling guide to getting rich quick. In fact, Buffett would later joke it was one of the driest books ever written, but inside its pages were the timeless rules that gave him the blueprint for becoming one of the wealthiest people on earth. The book was The Intelligent Investor by his mentor Benjamin Graham. To this day, Buffett calls it by far the best book on investing ever written. So today, we're cracking open the lessons from that very book. We'll show you the 7 core rules that built Buffett's fortune, the exact moments he used them, and how you can use them to protect and grow your own money. Rule 1. Think like an owner, not a trader. The first rule isn't just a tip, it's a complete shift in your mindset. Graham's big idea was that you have to see a stock as what it really is, a small piece of a living, breathing business. As he said, investing is most intelligent when it is most businesslike. It sounds simple, right? But it changes everything. A day trader is obsessed with the squiggly lines on a chart. A speculator chases hype, praying they can flip a stock for a quick profit. But an owner cares about the long-term health and earning power of the actual company. This is exactly why Buffett has his famous 10-year test. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. And he practices what he preaches. When he famously invested over $1 billion in Coca-Cola, he wasn't betting on a good quarter. He was buying a piece of a global powerhouse with a brand so strong it was basically a fortress, an economic moat that he knew would be selling more drinks in 10, 20, and even 50 years. He bought a business, not a stock ticker. That's rule number 1. Rule 2. Protect yourself with a margin of safety. This next rule is what Benjamin Graham called the central concept of investment, the margin of safety. Buffett considers this the 3 most important words in investing. Think of it like this. You're building a bridge that needs to support a 10,000-pound truck. You wouldn't design it to hold exactly 10,000 pounds, would you? Of course not. You'd build it to hold 25,000 pounds. That massive cushion is your margin of safety. It protects you from bad luck or a calculation error. In investing, it means you only buy a stock when its price on the market is significantly below what the business is actually worth. Graham's goal was to buy $1 worth of business for 50 cents. The perfect example comes from Graham himself. His firm bought stock in the insurance company GEICO when the price was so ridiculously low that it gave them a massive cushion. Graham made a fortune. Years later, a young Buffett who had studied Graham's success made his own personal investment in GEICO after visiting their headquarters. Decades after that, he had Berkshire Hathaway buy a massive stake, eventually owning the whole company and turning it into one of his legendary multi-billion-dollar wins. The price you pay is everything. A low price gives you a margin of safety, and that's the best protection you can get. Rule 3. Ignore Mr. Market. This might be the most brilliant analogy in the history of finance. Graham asks you to imagine you have a business partner named Mr. Market. Every single day, he knocks on your door and offers to either buy you out or sell you his half of the business. The only problem, Mr. Market is a complete emotional wreck. Some days, he's euphoric. He sees nothing but sunshine and rainbows and offers you a sky-high price for your shares. On other days, he's a sobbing, pessimistic mess, convinced the world is ending, and he offers to sell you his shares for pennies on the dollar. Now, here's where most people go wrong. They let Mr. Market's mood swings control their own. They get giddy when he's happy and buy high. They get terrified when he's panicking and sell low. The intelligent investor knows better. You're free to ignore him completely, or even better, you can take advantage of him. When he shows up crying in a panic, you can happily take those bargain shares off his hands. When he's manically optimistic, maybe you consider selling him yours. This is Buffett putting that idea into action when he says, be fearful when others are greedy, and greedy only when others are fearful. During the 2008 financial crisis, when the world was in a full-blown panic, Buffett was busy investing billions in pillars of American industry like Goldman Sachs. He wasn't catching the panic, he was using it. The market is there to serve you, not to guide you. By the way, if you're finding these rules valuable, do me a quick favor and hit that like button. It's a small click for you, but it tells the YouTube algorithm that we're delivering the goods and helps the channel find more people who want to become smarter investors. Thanks a bunch. Now let's get back to it. Rule 4. Stay inside your circle of competence. This is one of Buffett's most famous rules, and it's built directly on Graham's foundation of doing your homework. Buffett's version is simple. Never invest in a business you can't understand. He argues argues that real risk isn't a volatile stock price. Real risk comes from not knowing what you're doing. You don't have to be an expert on every company out there. Your job is to wait patiently for a business you do understand to be offered at a great price. For years, people relentlessly criticized Buffett for sitting out the tech boom of the late 90s. He freely admitted it. He just didn't understand how many of those new internet companies were going to make money or stay ahead of the competition, so he sat on his hands. People called him a dinosaur. Then the dot-com bubble burst. Investors who had chased hype they couldn't explain lost their shirts. Meanwhile, Buffett was happily invested in things he understood inside and out, like See's Candies, a simple, predictable business that sells chocolate with a brand people love. He stuck to his circle. Knowing the edge of your own knowledge is one of the most powerful tools you have. Rule 5. Focus on quality, not just a bargain. Now, this is where Buffett, with a big assist from his partner Charlie Munger, really evolved Graham's original ideas. Graham's early strategy was famously called cigar butt investing. The idea was to walk around looking for a discarded cigar butt on the street that had one good puff left in it. It's gross, but you get it for free. He'd buy deeply unloved, often mediocre companies simply because they were statistically cheap. But as Buffett's career went on, he realized something crucial. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Why? Because time is the best friend of a great business, but it's the enemy of a mediocre one. A struggling company, even if you buy it for dirt cheap, will likely keep struggling, but a truly wonderful business, one with a durable competitive advantage, will compound its value year after year after year. Think back to Coca-Cola. He didn't buy it because it was a cigar butt. He bought it because it was a world-class business whose value he knew would grow for decades. This pivot from just cheap to great is a cornerstone of Berkshire Hathaway's incredible success. Rule 6. Play the long game. Graham drew a brilliant distinction. He said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. What does that mean? In the short term, stock prices are just a popularity contest. It's all about emotion, news headlines, and hype. That's the voting. But over the long term, what determines a stock's value is the company's actual weight, its profits, its assets, its cash flow. That's the weighing. The intelligent investor tunes out the daily voting and focuses entirely on the eventual weighing. It's why Buffett says, our favorite holding period is forever. He isn't trying to guess the market's next move. It's a common trap to think fortunes are made by timing the market. But true, generational wealth is built by owning fantastic businesses and patiently letting them do their thing. The weighing machine always wins in the end. Rule 7. Master your own mind. The final rule is the one that holds everything else together. Graham wrote that the investor's chief problem, and even his worst enemy, is likely to be himself. Buffett couldn't agree more, saying that you need a sound intellectual framework, but you also need the emotional strength to stop yourself from destroying it. All the analysis and business knowledge in the world is totally useless if you panic and sell everything in a market crash, or get greedy and pile into a bubble at the top. You can have a genius level IQ, but if you can't get a handle on your emotions, you're toast as an investor. Think about it. Every single rule we've talked about is a weapon against your own worst instincts. A margin of safety protects you from fear and overconfidence. Understanding Mr. Market helps you break away from the herd. Your circle of competence stops you from chasing shiny objects you don't understand. Buffett's genius isn't just about spreadsheets. It's about being the master of his own psychology. He doesn't get carried away by the crowd. He relies on his research, his reason, and the unshakable principles he learned from Graham all those years ago. As Graham put it, you are right not because others agree with you, but because your facts and reasoning are right. So there you have it, the 7 guiding principles built on the foundation of a single book that were perfected by the greatest investor of all time. Think like you own the business. Always demand a margin of safety. Treat the market as your servant, not your guide. Know what you know and stick to it. Choose wonderful businesses over cheap ones. Focus on the long term, let the weighing machine work. And above, all control your emotions. These aren't secret formulas. They're a philosophy, a framework for behaving rationally when everyone else is going crazy. They were true when Graham wrote them in 1949, and they're just as true today. The hard part isn't learning them, it's having the discipline to actually live by them. Thanks so much for watching. If you want to keep learning how to be a more intelligent investor, be sure to subscribe for more deep dives just like this one. And drop a comment below. Which of these 7 rules do you personally find the hardest to follow? I read every single response. See you in the next one.